Well, it's the 1 o'clock hour, so we're going to get started with today's webinar. We're titling this Updated Supply-Demand Price Prospects for Corn and Soybeans. And the update that we're going to attempt to provide follows today's USDA reports on June 1 grain stocks and planted acreage report. I'm Darrell Good, and joining me today is Todd Hubbs. Scott Irwin was scheduled to be with us, but is sick today, so not able to join us. So Todd and I will try to carry the load. Just a quick reminder that the downloads for today's presentation are available at our FarmDoc website, as indicated on this by the address on the screen here. We will have a video of today's presentation up fairly quickly, and certainly that will be available by Monday. Two things as you look at your GoToMeeting webpage. You can download the slides from there as well right now if you would like. Those are available, and you can click on that for download. And secondly, and just as important, there's a place there on the upper right-hand side of your screen, a place to ask questions. We encourage you to do that. If you have questions as we go through the presentation, go ahead and submit those, and then we will have time at the end to address those. Our plan is to spend about 30 minutes or so making our presentation and then allowing 30 minutes for questions at the end. The way we've decided to allocate the presentation is Todd is going to talk a bit about the corn stocks report and the implications for the old crop balance sheet and prices. I will then talk about the acreage report and the implications for the new crop balance sheet and prices, and then we will repeat that same scenario for soybeans, stocks, old crop, acreage, new crop. So at this juncture, I'm just going to turn it over to Todd and let him take a look at the corn stocks implications.
Good afternoon. USDA released their grain stocks reports this morning, and June 1st corn stocks came in at 5,225 million bushels, which was slightly higher than what I was expecting, but it has definite implications for total use of this marketing year, in particular the feed and residual category. Trade had it at about 5,123 million bushels, and the June 1st stocks came in slightly above that, 102 million bushels above it. As we move forward through the rest of this marketing year, how much feed's being used out there, and in particular export markets and ethanol grind, are going to be very crucial to what that final ending stocks number is going to be, and I'll have more to say about that in a minute. Third quarter feed and residual use was 965 million bushels, which, as you'll see in a moment, is not really putting us on track to hit the 5,500 million bushels that USDA has estimated for the 16-17 marketing year. It's slightly lower than what I expected, and it does have us, I think, behind schedule. The feed and residual use for the first three quarters came in at 4,757 million bushels. And considering the amount of livestock increase we've seen, I think cattle have been trending up, hog numbers have been up 2 to 3, hatchery and broiler placements have been up 2 to 3. We've had strong livestock growth. Feed and residual doesn't seem to be reflecting that from a corn use perspective as we're moving through this marketing year. To reach the 5,500 that USDA is projected for the 16-17 marketing year, we need 743 million bushels of feed and residual in the fourth quarter. We haven't seen that kind of level since 2006, 2007, and I know I'm a bit skeptical about hitting that number this year, and you'll see that as we update our 16-17 report. Now, having said that, we've got a little estimation here between June 1st stock surprises and the change in the WASDE feed and residual in July. And normally what you would see is about a 50% change, as you can see from the regression line there, between the June 1st stock surprise and what WASDE reports for their feed and residual. So this would look at about 50 to 55 million bushel reduction. I don't expect that to happen, Darrell. I don't see that happening in July, but
Yeah, I wouldn't be surprised that they adjusted just a bit. The question is going to be how much, and then also, as the next slide will show, the real question is where do we end up at year end?
Yeah, year end, we see a 102, surprise on stock estimates, about a 40% difference lower if we have a positive surprise, and what's what we had this year. That's putting it about 40 million bushels lower than their current estimate. I think it might be more than that by the time we hit the end of 16-17. And as such, you can see our 16-17 balance sheet for corn right here. Nothing's changed in supply since the last time we talked to you in March, and we're still sticking with those numbers, including import numbers. We've got feed and residual 100 million bushels less than the current 5,500 million bushels. We'll see what the USDA does as we move through July and August. We're definitely not on track to hit that 5,500 number. We still think, and I still think, ethanol grind looks strong. I think that number is pretty good. We might even come in above that by the time the end of the marketing year, but we're sticking with 5,450 million bushels. And through this marketing year, we've seen growth in other industrial uses as we move through the marketing year, particularly in glucose and dextrose and starch. So maybe that'll be some support for use as we move through the final quarter of the marketing year. Exports have been strong. We have it 25 million bushels higher than USDA's current estimate. I think that's very attainable, and we'll see as we move through the last quarter of the marketing year. So that puts us as a total consumption of 14,570 million bushels with an ending stocks of 2,370, mainly on lower feed and residual use, which put the ending stocks to use number at 16.3%. And that's a slightly higher carryout than we've been saying in the past.
Yeah, so I think in summary, what we would see is the June 1 stocks number, I think, in terms of overall fundamentals, was a little bit bearish for corn.
That's right.
Showing less feed and residual use than we need. We're running about 5% above last year, and as Todd said, if we're 5% higher in the fourth quarter, then we come in at 5,400 rather than 55. So USDA may not make that big a change, but I think that's really where we're headed at this point.
Yeah, I agree.
So now that we look at the acreage report and the implications for new crop corn, we like to start with kind of accounting for the crop acres in the U.S. And this little table looks at acreage broken down into three categories for the last several years. Planted acres of principal crops, CRP acreage, and prevent plant. For the current year, the June acreage report would put acreage of principal crops at 318.2 million. That's a million less than last year. As indicated by the footnote, that's about 1.3 million acres more than indicated in March intentions. CRP enrollment last fall, 23.4 million. Prevent plant, obviously we don't know yet. As history says that varies quite a bit, obviously depending on spring weather. Weather this year was a bit of a mixed bag. We've plugged in 2.5 million acres as potentially prevent plant, but won't know until we start getting those reports from FSA in August. Total acreage then at 344.1 million would put us at the low end of where we've been, even lower than last year's number by 2.4 million acres. So right now we are seeing what we would describe as some response to low commodity prices as taking some acreage out of production in 2017. When we look at corn acres, the report today indicated that planted acres at 90,886,000. That compares to the March forecast of 89,996, so about 900,000 acres more than indicated in March, and about 3.7 million acres more than planted last year, and a bit more than the average trade guess that came in at 89,903. So bigger stocks, bigger acreage than the market had guessed. Looking at harvested acres of just about 83.5 million acres for the current year. Again, that would be down from last year. If we look at the geography of where the acreage is changing from last year, the blue states increasing acreage, the red states declining. So you have more states coming down than going up. But it is also interesting to look at June intentions compared to March. What we've seen is some substantial acreage changes from March intentions for individual states. North Dakota up 400,000, Iowa up, Nebraska up, Wisconsin up. The declines in acreage compared to March intentions are primarily Eastern Corn Belt, Illinois, Indiana, Ohio, and then South Dakota as well. So the biggest change in North Dakota, again, 400,000 acres increase. Where we will eventually get on planted acres is still unknown. What this figure 12 shows is that the actual planted acres at the end of the marketing year does differ from June intentions. Sometimes those are pretty big, as much as a couple million acres. Typically less than 500,000 acre difference between intentions and final plantings. There is a general tendency since 1996 for acreage to be less than indicated in June, and I would guess that might be the case again this year. Wouldn't be surprised to see some smaller acreage, some additional switch to soybeans, and perhaps some prevented planting that was not picked up in the June survey. But I recognize we're still working with a tentative number on both planted and harvested acreage of corn. This looks at the difference between planted and harvested acreage of corn. The biggest difference, of course, is acreage that gets harvested for silage, then some abandoned acres depending on the year, 2012, 2002, quite a bit of abandoned acres. USDA is looking here at just under 7.4 million acres difference between planted and harvested for this year, and that certainly seems reasonable given where we've been the last 2 or 3 years. The big question, obviously, moving forward now is what kind of average yield will we end up with? As most people do, we start with an estimate of trend yield. Here we just look at 1960 forward linear trend. Unconditional, the trend for 2017 would be 168.2. We argue that the conditional trend would be a bit higher than that, acknowledging the fact that bad weather hurts yields more than good weather helps yields. So if you have normal weather, you would expect the trend to be just a bit higher than 168.2, perhaps closer to 169 would be the trend for 2017. So when we do our balance sheet and compare that to what USDA said earlier this month, we've got 900,000 more acres planted, about 1.1 million more harvested. We're using a yield at this juncture of 170 bushels per acre. That's pretty close to what we were using in March. It's a little bit less than USDA's calculation of trend yield, and certainly is debatable. We're just entering the critical part of the growing season. As Todd said, there's a lot of focus on the Upper Plains, North Dakota, what's happening there. And so July weather will certainly impact our expectation. But at the current point, we're suggesting yields are still on track for trend or very close to trend. That would give us a crop of almost 14.2 billion bushels, a total supply of just over 16.6 billion, about 200 million bushels more than indicated in the June WASDE because of the larger carryover and larger acreage that we're using compared to then. Feed and residual use of corn for the upcoming year, we've pumped that back up to 5.5 billion, suggesting the current expansion in livestock numbers, the higher wheat prices, the larger production number will help support both feed and residual use of corn. We're bumping ethanol use up to 5.525 billion bushels for next year, a bit higher than what the USDA has carried in its balance sheet. Exports, we see exports on the decline in the coming year, consistent with the USDA projection, primarily based on large competition from the current South American crop, and assuming they have another normal crop in 2018, I think that could displace some of the good exports that we've seen this year. Total consumption at 14.4, carryover at 2.2, which is a 15.4 stocks to use ratio. Pretty consistent with what we're seeing this year. But as you see, we have plugged in a slightly higher price, $3.70 as an expected price. We've talked about this, how we get to our price a little bit in the past. We bank heavily on the stocks to use ratio, but over time we're suggesting that the actual relationship between stocks to use and price is pretty dependent on whether we're in a weak or strong demand environment. We've recently been in a weak demand environment and probably continue to be so. Maybe we're improving somewhat because of some economic growth, and maybe we're moving up towards the moderate demand scenario. What our price of $3.70 reflects is somewhere in between there. You see the fit to the regression line. If you plug in 15.4% as X and calculate the average price, then the average of those two relationships is pretty close to $3.70, and that's where we're putting in our balance sheet at the current time. Again, highlighting the fact that there's a lot still to be determined about that balance sheet on the supply side over the next 6 weeks.
June 1st soybean stocks came in at 963 million bushels. I think, that's pretty close to what the trade estimate was, about 20 million bushels above their average guess of 983. It really does set soybean use on track for what we're seeing for the balance sheet for the 16-17 marketing year, what we saw the USDA produce on June 9th, and what we see for the 16-17 balance sheet. Same supply numbers, nothing's changed. We have seen some weakness in crush through the spring a little bit. I mean, it's picking back up a little bit, but that 1.9 billion bushels, we're sticking with that number. We have upped the export slightly to 2.065 billion bushels. We've seen some strength in exports, maybe stronger than what we expected earlier in the year, despite the fact that the Brazilian crop's starting to come on the market. We see it at about 2.065 billion bushels. No change in seed and residual, which puts total consumption at 4.093 billion bushels, which sets our ending stocks number at 435, which is a 10.6% stocks to use. And we're sticking with that average farmer price of $9.55. So overall, the soybean stocks report, I think, is relatively neutral to the market for the 16-17 marketing year. It pretty much fit into the range expected for the stocks number. And there's really not too much information there to change the mind on 16-17 price or consumption patterns.
Yeah, I think Todd, the market interpreted the 20 million bushels as important to the soybean market, but as you indicate, 20 million was certainly within the range of guesses by the trade. And what you have to ask is, do you change your expectation about seed and residual use of soybeans for the year based on the stocks on June 1? And the answer is there's so much noise in those quarterly numbers that you really can't change your expectation for the year from 118 at this point.
And the second quarter, we were minus 44.8 on seed and residual, and then we're up this quarter. There's a lot of noise this year in the seed and residual, and I can't see a reason to change that number right now. And we'll find out in September. But, yeah, I think it's relatively neutral. I don't see where that's coming from the market.
Yeah, so for the stocks reports, then we would see the corn as a little bit unfriendly for what it reveals about feed use of corn, and the soybean number kind of a neutral number for the marketplace. So for soybeans, then in particular, this puts all the emphasis back on new crop, and for the current period, it's really looking at prospective supply, size of the U.S. crop. The June acreage survey put planted acres at 89.5 million. As the footnote indicates there, that's very close to March intentions of 89.482 million, and it's slightly less than the average trade guess of 89.75. So anecdotally, the way the market is reacting to this report would say that the market was probably really trading a much bigger number than revealed by the average trade guess of 89.75 million acres. I think the market really expected that to go well over 90 million acres in today's report.
I think that's right.
And since it didn't happen, then the market is taking a sigh of relief.
Taking a run, yeah.
Harvested acres at 88.7 million, and that's 800,000 acres, or a little less than the planted acres number.
That's right.
Again, just out of curiosity, looking at the geographic distribution of acreage changes this year compared to last year, like the corn map, this is one we steal from NASS that they release with their summary of today's reports. And you can see blue states where soybean acreage is increasing, and the biggest increase, of course, is coming in North Dakota. Few states to the southeast and east with slightly smaller soybean acreage. Again, I thought it was curious to look at how today's numbers differed from March intentions. The biggest change, once again, was in North Dakota, where they're showing 400,000 acres more than indicated in March.
That's a surprise.
And so when you look at corn and soybeans, 800,000 acres more in North Dakota than reported in March. We're also seeing a pretty good increase in Missouri, 350,000, Illinois, 200,000 acres more than indicated in March. And then Kansas also up. And Kansas down, 250,000 acres. And then a lot of states with small declines in acreage. So again, it's North Dakota, Missouri, Illinois, showing more beans than indicated in March. A lot of people have picked up, I think, on the tendency in the difference between the June intentions and where we come in with the final estimate of planted acres in January. And as you can see, over the last 21 years, there has been a tendency for acreage to come in smaller than June intentions. But certainly that's not always the case, and prevented plantings has a lot to do with that, I think, because in June we're still reflecting intentions in a lot of cases. So where we come out this year, I think we could see acreage a bit larger than indicated in June, as I think perhaps we did end up switching a few more acres out of corn into soybeans than indicated at the time this survey was taken. That's opinion. Probably will not be a large increase or decrease either direction, but I think we may see a slight bump up when we get there. That'll be late enough that it won't make any difference to the market at that point. But but it will reflect perhaps in the production estimates as we start getting those in August.
Yeah.
Planted minus harvested acreage, again, we see that difference is typically fairly small, typically less than 1 million acres difference between planted and harvested. It reflects entirely abandoned acres because of crop loss. USDA coming in at just under 800,000 acres difference, again, seems reasonable at this juncture until we see more about summer weather and how we end up the growing season. Soybean yields, this is where we probably have more discussion than we would on corn, and this is something we've written about quite a bit on Farm Doc Daily recently, what's happening to the trend yield for soybeans. We've historically used just a linear trend from 1960 forward as an expectation of current year unconditional trend. And if we did that for 2017, we would be at 46.3. Conditionally, again, recognizing the asymmetric effect of good and bad weather, we might add a couple tenths to that. So the linear trend would be somewhere around 46.5. But like others, we're a little bit concerned about the pattern of actual yields being well above the linear trend in recent years, and the implications of whether the trend has changed or not, whether we're still dealing with a linear trend. So we've looked at it a couple different ways. One is we have tried to fit a quadratic trend to that would account for increasing yields at an increasing rate in recent years. And if that has a fairly good fit, the R squared is almost 0.91, so that the quadratic is explaining 91% of the annual variation in yields, and would point to a trend this year of 48.1. The problem I have with a quadratic yield trend is one would not really expect that to persist indefinitely. Increasing at an increasing rate in another 4, 5, 6 years get you at a very high trend yield.
Yeah.
And so while it does fit what's happened so far, I'm not sure it's good for forecasting very far into the future.
That's right.
And now Todd has taken another look at yields and in a linear sense, looking at the trend, but has tried to identify whether the magnitude of that trend has changed. And statistically, there does seem to be a break a bit in the early 90s. We show here a linear trend 1960 through 1990, and then a higher trend from 1990 forward, and the trend is basically increased from about 0.3 of a bushel to almost 0.5 of a bushel per year. The fit is fairly good. You still see that the linear trend is less than actual yields in recent years, but it does fit just a little bit better than a linear trend for the whole period. So, Todd, what are we looking at here on trend yields for soybean?
Somewhere between 46.5 and 48.3. We did a few articles on this. We were looking at irrigated acreage, state-by-state acreage, and when you look at the southeastern states and a lot of irrigated acreage in, say, Nebraska and Mississippi, they definitely have a quadratic fit over the last 40 years or so. And it really did start in the early 90s. You could see it. You can sort of see it in our quadratic fit of the national trend. It's hard to say when the break actually occurred. I've seen people talk about 83. I've seen people move it over farther. I'm sort of leaning toward this 90 break. I feel pretty comfortable with that 47.2, but it's hard to argue what's happened the last 3 years. So I don't think it behooves anybody out there to use short sample trends. I've had a few questions about this, and people talking about 5-year trends or breaking trends into 3-year. I don't think there's any good benefit to come from that. So as we look over the long span of things, I saw this 90 trend break. I feel sort of like that might be close to where I'm thinking it's going, but we'll see as we move through the next few years.
Yeah, we don't want to beat this horse too hard, but I see one of the questions is why do we think the yield trend has changed? And I think we're confident that a part of that is associated with change in production practices in the Mid-South. We've seen them move to much earlier planting dates on soybeans beginning in the 90s, and a move towards earlier season
different
soybean
maturity
varieties.
Groups. 3-4 maturity groups,
Right.
sort of like planting like we do in the Corn Belt.
Right. So I think when you look at, as Todd said, when you look at it state by state and you see where yields have been increasing at an increasing rate, it's been on a combination of irrigated acres and on acres in the Mid-South. You see it really clearly in a state like Arkansas that yields have been increasing at a more rapid rate. Can that rate persist, or will it flatten out? Those are all issues to be determined. We'll let you know in 10 years. But I think we have to acknowledge that perhaps there has been a change from the long-term linear trend. The question then is, what is the trend, and then how how do we think yields will deviate from trend this year? And as Todd said, the trend is somewhere between 46.5 and 48.5 bushels.
We're exact.
So, but 2 bushels makes a lot of difference on the balance sheet. What we're sticking with for the moment is our yield that we calculated in our March presentation, 48.2 bushels per acre. Again, as with corn, we're not yet into the critical part of the growing season where that will be determined. So it is subject to change, but as a what-if scenario, we're looking at harvested acreage at 88.7 million, a crop of 4.275 billion, and a total supply of 4.735 billion. So that's a large supply, not much different than what USDA was projecting earlier this month. And so with that large supply, our consumption is going to be important. And this is where I think there's a lot of difference of opinion. When you look at the 2 major categories of consumption, domestic crush and export, we think crush is on good footing with the domestic soybean meal demand. Biodiesel demand will support crush. Exports we're concerned about a bit because of the large South American crops, and the estimated size of those crops seems to be increasing. It certainly did earlier this month.
Yeah, they just keep going up.
And I think that could provide a lot of competition for us, particularly if South America can avoid problems in 2018 that would affect the last half of our marketing year. We see perhaps exports softer than what USDA is projecting and down a bit, down about 65 million bushels from this year, 150 million bushels less than USDA. So we would see total consumption at this juncture of less than 4.1 billion bushels. And just strictly doing the math, that would give us a pretty massive ending stocks of soybeans, 650 million bushels, almost a 16% stocks to use ratio. Again, that's almost 4 points higher, 4.2 points higher than what USDA was looking at earlier this month. And we think that would result in obviously a lower price of soybeans. We've using $8.90, and again, that's derived fundamentally from our stocks to use models that show a reciprocal relationship between stocks to use and price. And if we plug in our projected ending stocks of 15.9% as X in this formula, and we do the calculation under a weak demand scenario, then we come out at that $8.90 level. So whether carryover stocks are as big as 650 or not, stocks seem like they're going to be plentiful for the 2017-18 marketing year. Certainly envision no shortage of soybeans at this point. So we probably have little else to say at this point in terms of fundamentals as it affects the balance sheet. We would ask that if you have questions that you go ahead and submit those at this point. We have not received many. We will try to address those to the best of our ability. And as you're doing that, we would also remind you that we do have a webinar scheduled for later this summer following the first USDA production forecast for the year. That will be at August 11th at 8 in the morning. So let's just take a quick look at some of the questions that are coming in and try to respond to those.
Given the apparent neutral bearish numbers, why are markets up so much? I think Daryl hit on that earlier. I think the markets were pricing in a bigger acreage number, and we didn't see it materialize to, I think, a lot of people, to my surprise at least. And it's today likely to be a one-hit wonder. But I don't know if it's a one-hit wonder. I mean, we might see this carry out a little bit, but as we move through the rest of the summer, and we see the export numbers come in like I think they might, moving into 17, 18, I think we'll see weakness in soybean prices. Daryl, you can add something to that, but.
Yeah, I think, as I said earlier, I think the market was kind of leaning the wrong way going into this report, thinking that soybean acreage could be higher than it was, and also since stocks were a bit smaller, we're seeing a pretty good response. I wouldn't be surprised as well that the market is also beginning to trade weather perhaps a little more heavily. We're seeing concerns about North Dakota in particular, and that's been apparent in the spring wheat market and the wheat market in general. And with the North Dakota having about 4% of the corn acres, 8% of the soybean acres, then significant problems there would drive that national yield down a bit below trend. And so I think the market's beginning to trade that a little bit as well. And if it continues to do so, then it's this kind of price reaction that, from a producer standpoint, then you have to be more serious about the pricing question as the market moves new crop bids, harvest delivery back well above the $9 level again. Then it's going to be providing some opportunities for some additional sales of new crops.
Yeah, the North Dakota acreage was a big surprise to me, especially in corn and soybeans.
Need to speak up.
Yeah, the North Dakota acreage is a big surprise to me, especially the corn and soybean acres being that high. We'll see how that turns out. What impact will the value of the dollar have on exports? It has been trending down. Any help? It can. I've actually spent quite a bit of time trying to figure out how exchange rates impact corn and soybean prices. It's a pretty tough question. When you see the stocks low, when you see the stocks high, you get a sort of a different reaction function from exchange rate changes. So I think if we see a weakening dollar, we could see that help a little bit. I think the overall price of soybeans coming down will help exports markets more, relatively speaking, but we have seen the Brazilian currency weaken significantly in the last month, and they are our main competitors. So I'm not sure it would be relative to Brazil's real, I believe, to get any kind of good reaction. I hope that helps some.
So we're getting a question, do current crop conditions support your yield projections? The short answer is yes. So we kind of get at yield prospects from 2 points of view. One is the crop condition ratings, but also recognize that those ratings tend to be biased early in the season, that on average ratings at the end of the year, which are fairly highly correlated to yield, tend to be lower than ratings early in the growing season. It's just a fact of life that it's hard for crops to look bad early in the season for the most part. The color is there. So when we plug in current crop condition ratings, adjust for end of year bias, they do support our forecasts, and we also have a bit of a crop weather model where we look at yield prospects as a function of summer weather. And obviously, we're just now getting through June, so we don't have actual weather data for the critical part of the growing season yet. But assuming normal conditions through July and August, current conditions and weather to date would support the kind of trend yield forecast that we're using at this point.
Yeah. Do you believe the Trump administration will have any impact on the prices of corn and soybeans? I'm going to say no. Daryl, maybe. I don't see how that's. I know it affects exports and imports. Pulling out of the TPP, talking about renegotiating NAFTA, those don't help the export market at all. But I can't see anything right now that's going to impact it. Daryl might have some insight into that.
No, I think the most concern at this point has been the effort to renegotiate NAFTA and what that might do, in particular to corn exports to Mexico. Mexico has been pretty vocal about saying that they're going to buy corn from South America rather than the U.S., and I think they've done some of that. And if you look at new crop export sales at this point, while it's very early, sales to Mexico are a bit less than they were this time last year, but only by about 10 million bushels.
Not large.
The big question then is to recognize that the corn is a world market, and if Mexico says, hey, we're not going to buy U.S. corn, we're going to buy South American corn, the total supply and total demand for corn doesn't change. That means if Mexico is taking corn out of Brazil, somebody else will have to take U.S. corn. It's a kind of a zero-sum game. So I think the concerns are a little bit overblown at this point in terms of the impact that the new administration might have on total export demand for corn and soybeans. We did get a question about feed and residual use of corn maybe going higher because of the new China beef trade deal that the new Secretary of Agriculture have been championing. I just respond that, to get more corn use for beef production means you have to expand beef production. That doesn't happen quickly. So if you want to say in the long run, that's probably a positive development. If total demand for U.S. beef through the export market increases and we get some expansion in production, that's certainly positive for feed consumption of all types. It doesn't happen overnight. It won't happen this marketing year, but as we go into next year and beyond, it could be beneficial at the margin. We did get a question about NAFTA, but I think we've probably addressed that the best we can. We get a question, do lower energy prices impact ethanol corn demand? Again, the short answer, I think, is no. This is where we would lean on Scott quite a bit to answer this question, but recognizing that the bulk of our ethanol demand is mandate driven. So we're going to continue to blend everything at 10% domestically. So lower energy prices won't affect the blend. Where it might have a positive impact is if we do see a response in terms of consumption of gasoline, more miles driven, more total fuel consumption, recognizing that everything is blended at 10%, that is a positive. That's not only the U.S., but worldwide. We have seen quite a bit of strength in ethanol exports as the world has become aware of its octane advantages, I think. And so there is a move to use more ethanol around the world, and as long as Brazil is out of the market for the most part, that opens the door for us. So in general, I think lower energy prices it could be a slight positive for ethanol consumption and therefore corn consumption.
I think that's right. And we're seeing it this marketing year in a lot of ways with how much ethanol consumption there's been. So, yeah, I think a slight positive. So we get a question, what happens to your soybean balance sheet if biodiesel credit goes to producer rather than blender? That's something we've thought about, and again, this is where we miss Scott a bit. He's been the leader in terms of thinking about these issues, and the answer I don't think is straightforward.
clearly we've been importing a lot of biodiesel and a lot of that from Argentina because of low soybean oil prices in Argentina means that they can make and export biodiesel very competitive with the U.S. So we've imported rather than rely on domestic supplies at the margin. What happens if you go to a producer credit? Then you say, okay, now we're probably going to choke off some of those imports.
Yeah.
And more production will have to take place here in the U.S., but does it change the demand for feedstocks in total? Now Argentina would have soybean oil that was going into biodiesel that no longer will. It will be available to the world market. The U.S. will be forced perhaps to use more biodiesel than if we were use more soybean oil than if we were importing biodiesel. But again, it appears to perhaps to be a zero-sum game in terms of the demand for feedstock. It's just where is it sourced, South America or somewhere else, or the U.S. So at this juncture, it wouldn't change our balance sheet much because we might be exporting less soybean oil, importing more soybean oil. And using more soybean oil domestically. So in that terms, it might affect the soybean oil balance sheet in terms of what category use takes place in, but I don't think it would alter the bottom line very much.
It would be a tight run thing, maybe slightly more, I think. But yeah, the substitution's there for soy oil.
So we're not seeing any more questions at this point. So we're willing to give it up a little bit early unless you have some additional questions. We will thank you for your participation and look forward to visiting again on August 11th at 8 o'clock. Thank you.